There is a saying about numbers. They hide more than what they reveal. Now, is this true? Is this applicable in your investing journey also? Can you depend solely on platforms and screeners available which give you financial data and ratios on a ready-made platter? The plain simple answer is no. Screeners often don't give you the complete picture. Yes, they become a starting point of your analysis. That is where you shortlist the companies from the larger universe for further analysis. But that's where the role ends. They become a shortlisting tool and not a final analysis tool. Today, we will take the example of Cafe Coffee Day. We will look at a few screeners. We will see what the screeners tell us and what is the actual situation on the ground. And what I'm going to tell you might really surprise you. So, do watch the complete video. So let's quickly open the screener app. As per the screener, Cafe Coffee Day had a fantastic profitable quarter of 69 crores. It is one of those loss to profit stories which the screener tells us or the screen identifies as. Last year, its sales was 994 crores and the trailing 12-month sale is slightly above that. So that's all right. It has a profit after tax of 133 crores last year. Its price to book value is 0.37 times against the industry price to book value of 7.77 times, which is again fantastic. The stock PE is 8.76 times against an industry-wide PE of 135 times. That's again very, very attractive. So a company which is turning around, which has moved from loss to profit, a company with a market cap to sales of 1.15 times, a company with a price to book value of 0.3 and a stock PE of less than in single digits. Wow. First thought is it's a steal of a century. It's the investment which will really triple and quadruple my money in very quick time. But is this the reality? Is this the performance? No, not really. So what I did was, I simply downloaded all the data available of the company, the financial reports, the annual reports, the quarterly disclosures in terms of financial numbers which the company makes, the charge documents of the company, and I simply read through all of it. What it tells me really startled me and really revalidated my thought process that screener is only a first point of investment analysis. We will take numbers of 9-month ended December 23. First, the company reported a net loss of 20 crores for this period with a net profit of 69 crore for the latest quarter, which is the December quarter ending 31st December 2023. Now, December 23 quarter also included a one-time profit from sale of assets of 71 crore. So if we simply look at that, then the quarter was a loss-making quarter and the loss was 2 crore. However, hidden in the footnotes is also another disclosure. The company has not recognized interest expenses to the tune of 102 crores. I repeat, the company has not recognized interest expenses to the tune of 102 crores. So that means for the 9-month ended December 2023, the net loss is not 20 crores as reported. It is 193.6 crores, which as a percentage of sale, the loss is 25%. Wow, that's a big number. I'll take another point. The company has a reported net worth of 3,430 crores. So that is where the market cap of the company being 1,000 crore today gives us a price to book ratio of 0.37 times. Now in the reported net worth, there are two things in the asset side which are really suspicious or which really stand out. One, there is an amount recoverable from MAECL to the tune of 3,391 crores. MAECL, for all of those you don't know, was a group company to which these advances were given, and then they were further transferred to other promoters and outside entities for God knows what. Are they recoverable? For the past 2 years, the auditors have been saying that they are not recoverable, and I don't see them recovering. There's another amount of 361 crore of goodwill which is appearing in books. Now, goodwill is something which is created when you buy assets or companies at a premium. In this case, as a standard accounting practice, you write off the goodwill in your books over a period of time. You depreciate it just like any other asset, and the company has not been depreciating it. So that 361 crore is also a book entry only and carries no value at all. Add to that the incremental losses due to unrecognized interest expenses over the past few quarters or more. And the result will be that the adjusted net worth will be negative in excess of 1,000 crore. So imagine what's reported is a positive net worth of 3,400 crores. If you just look at the screener, and what you get is an actual negative net worth of 1,000 crore. The differential of 4,500 crore. So that is where a screener is only the starting point of your investment decision. Once you filter out companies using a screener, then you have to go deep into each. You have to read through the annual reports. You have to read through the credit rating agencies' reports. You have to read through the newspaper clippings. You have to read through the macroeconomic situation of what is affecting the company. You have to read through the government policies which might affect the company. You have to read of the market conditions which are there. You have to read about the competition. And only then can you reach a final investment decision. With this, I will end this video. I do believe that this video would have added value to your investing acumen and decision making process. We will of course do a deep dive into Cafe Coffee Day and what went wrong with its business very soon. Until next video, happy investing.